If you're age 73 or above, do you know how to calculate your RMD? Do you know how much to take out this year to satisfy the IRS? Hi, I'm Garrett Ray, financial advisor here at the Wealth Guardians and the Ray Financial Group.
And I'm Brice, Payne, and you've entered The Vault, the Wealth Guardians video series on all things pertaining to retirement planning. In this episode, we're going to talk about what an RMD is, required minimum distribution, why they exist, and how to calculate your RMD. I will say at the start of the show, this topic is only regarding original owner RMDs. This is not covering inherited IRAs or inherited Roth IRAs, just so you know. Okay, Garrett, thanks for joining me on this one. Why don't we start off by just defining what an RMD is for people out there, required minimum distribution? Who has to take these out?
Yeah, so required minimum distribution, it applies to traditional IRAs or 401ks or company-sponsored plans. Traditional meaning that everything is all pre-tax. So if you make a contribution into your traditional 401k or your traditional IRA, you get to turn around when you file the next spring and take a deduction off of your income for that. So effectively, that contribution went into that account at no tax. The part of the agreement with the IRS is that eventually, when you get retirement age and you take that out as income, you will be taxed on it at whatever your income tax bracket is. When you get to a certain age, in this case, age 73 or higher, whether you want to or not, then the government forces you to take a certain amount out so that they can start to collect on that tax base that has been building up over the years. So that's what an RMD is.
And you also tackle why they exist, because the government wants their tax dollars. You can't keep it in there indefinitely. If you didn't need your IRA money or your 401k money, you just happen to save it, but you're making enough from a pension or from rental income or something, Social Security, and you don't need that money, well, then the idea would be if RMDs didn't exist, then you could pass this down to your kids, and they might not need it either, and they could pass it down to their kids, and the government would never be able to collect the tax dollars on it.
Right.
So Uncle Sam say, hey, this is just a temporary agreement, and this agreement only lasts up until you're 73. That's what an RMD is, why it exists. Now the question becomes, well, how do I calculate my RMD? And this is where we got to turn to a table, and that table we're going to throw up onto the screen here for you. So it starts at 73, the year that you turn 73. So let's say that you don't turn 73 until December 31st. Well, that was still the year that you turn 73. So at some point in that year, you are going to have to take out the calculated amount.
Yep.
Well, what's that going to be based on? How do we do that calculation? Well, first off, we have to get the amount, the value of the IRA on December 31st of the prior year. So if we're now in the year 2025, you turn 73 this year, and you're going to have to pay RMDs, you have to calculate the amount that your IRA account balance was on December 31st of 2024.
That's right.
All right.
Yep.
So whatever that might be. Now, I will say this, that a lot of people out there have more than one IRA. And the question can be very common. Do I have to, if I've got $500,000 in this IRA over here, and I've got $200,000 in this IRA over here, do I have to take the RMDs from each one of those in their proper percentages? The short answer is no, you don't. But if one of those IRAs was, say, a SEP IRA or a simple IRA or an inherited IRA, then you can't contaminate them, so to speak. You would have to take the proper RMD amount out of each of those. But if you have just simply 2 or 3 traditional IRAs out there, there's nothing funny about them. They're just simple ones. In that case, you could look at what the total value was.
The combined value.
Right.
Yep.
So that would be the example I just used. That would be $700,000. They had 500 in this one, 200 in that one. You got $700,000. You could take out the properly calculated RMD from just one of those. You don't have to take it out from each one. So there's that. So here we have on the graph, you're going to take a look at your age 73 there is 72 and 73 is the starting ones there. So that's the divisor next to it. So if you're 73, you see that number 26.5. Well, we're going to use an example here of the person who is 23.7 is 76.
Yep.
So in this example here, we've got the account balance of $100,000. We're going to divide that by the number 23.7. And this is taken from a particular table, the Uniform Lifetime Table, and it's the Uniform Lifetime Table 3 for, and it says right up there, for unmarried owners, married owners with spouses not more than 10 years younger, and married owners whose spouses are not the sole beneficiaries. I've always wondered about that last one, Garrett. How on earth does the IRS know who your beneficiary 20 years from now or 10 years from now is going to be in your IRA, so that you have to use a different table? I don't know that they have a way of really enforcing that or not. I'm not sure, but that's just, I've always found that interesting that is one of the qualifications. And married owners whose spouses are not the sole beneficiaries.
Right.
All right. So we've got $100,000. That was our December 31st balance of last year. We're 76 years old. So we're going to divide that by 23.7. And the RMD that person would have to take out in the year that they turn 76 would be $4,219.41. Again, don't have to take it all out of one IRA, or you could take it all out of one IRA. That's completely up to you. But if you had, let's say you had a SEP IRA out there, well, then we're not using this table, and you're going to have to take all the RMD just out of the SEP IRA.
That's right.
And that's pretty much it, plain and simple. So just look at the age there that you are, or maybe you're helping your parents out with their RMDs. Look at what age they are, and just take the December 31st value of that and divide it by that number. Here's something nice that custodian firms do out there. Let's say that you've got, Garrett, your IRA at Charles Schwab.
Yep.
Charles Schwab is nice enough on the January statement that you will receive. They will have calculated what your value was on December 31st, and they will generally put at the bottom of the statement what your RMD is for that year. They know that you're 73 because they have to know your age, and they'll say, hey, by the way, your RMD for this year is this amount, or your calculation is this amount. And so that's very helpful. Yep. But if you don't know that, if your custodian doesn't do that for you, well, then here's the chart that you want to look at.
Yep, absolutely.
And that's basically all I wanted to cover on this.
Yeah, the only thing I would add that's interesting that sometimes we have conversations with our clients about is that if you look at this table here and you look at the divisors, you'll notice that each and every year the divisor is a smaller number, which means that the result
is a bigger number
that you have to take out each and every year. So
if you're dividing by 2, like the 120-year-old is
right,
there,
that's 50%. That's 50%, right? So the RMD tax, if you will, is progressive, and so I always tell people that it starts out around 4% of your account value that you have in traditional IRAs, and then it progressively gets higher each and every year. So interesting food for thought there. Some people like that information. Some people get kind of irritated about that information. Yeah. But the idea being that hopefully as you get towards the end of life, a lot of this money has been discharged from the account and, of course, is taxed, which is the whole purpose and for the IRS behind it. So,
The one more thing that I'll add, maybe somebody's out there listening to this and they turned 73 this year or last year, and they thought, oh, I forgot I was supposed to be doing RMDs. My advisor didn't remind me of that. Holy cow, what do I do? Don't sweat. It's not the end of the world. Uncle Sam understands that when you turn 73, that was the first year you ever had to deal with this. Yep. They'll cut you a little bit of slack. You can go back and figure out what your RMD was for last year, and you can just add it to your RMD for this year. They're not letting you get away with it. But they're gonna give you a 1 year kind of leniency that first time around. Period. That first year around. So once you're 74, you need to have gotten on the ball at that point. So there you go. All right. Well, do want to thank you for joining us. That's going to wrap it up for this episode of The Vault. Again, look at them down there hanging out, waiting for you to click on them. The like, subscribe, the follow buttons. We'd love it if you do follow us. Always helps. But that's going to wrap it up for this episode of The Vault. I'm Brice Payne.
And I'm Garrett Ray.
And this has been The Vault. Hey, it's Brice Payne with the Wealth Guardians. Thanks for watching our weekly series, The Vault. Do you know we also have a weekly radio show where we discuss all things retirement? You can listen to the Wealth Guardians radio show live on 94.5 WPTI in the Triad on Saturday mornings. But if you miss the live broadcast, you can also catch it on our YouTube channel or find us on your favorite podcast platform each Saturday morning. Make sure to subscribe wherever you listen so you can get notifications when we release new episodes. Want you to remember, good retirement plans do not create themselves. We'll talk to you soon.